Hello, and a very warm welcome to our very first PIC Perspectives G20 Dialogues, which is a collaboration between Asset TV and the Public Investment Corporation. So I'm truly excited about today's conversation, where we're going to be unpacking from a very tangible and rich perspective what will it take to catalyze capital as well as accelerate infrastructure on the continent. And joining me is a very esteemed panel of experts who have deep experience facilitating investments on the continent. So I have joining us Sonia Saunderson, who is the Chief Investment Officer at the EPPF. We're also joined by Amadou Wada, who is a Senior Director at the African Finance Corporation. Leila Fourie, who is the Group CEO of the Johannesburg Stock Exchange, is joining us. And last but not least, we are joined by Kabelo Rikotso, who is the Chief Investment Officer at the Public Investment Corporation. Thank you all for being here and welcome to Asset TV. So, Cabello, I would like to kick off just to set the scene and give us some context. I would like to kick off with you. As the CIO of the Public Investment Corporation, you've led the development of this timely report around what can be done to accelerate infrastructure development in Africa. What inspired the PIC to, put this report together, and what are some of the key messages that you'd like people to take away about the opportunities for infrastructure in Africa?
Thank you, Masidi, and everyone who is listening to this program today. For PIC, infrastructure is not just a developmental goal. We believe it's the backbone of inclusive growth, regional integration, and social inclusion. If you look currently, 80% of infrastructure projects stall at the feasibility or planning phase. And as the PIC, we do not believe this is due to lack of ambition or ideas, but largely because of systemic delays driven by regulatory fragmentation, weak institutional capacity, and misalignment between policy and financing structures. From our vantage point, we believe it is critical that we reduce lead times between project conception, project financing, and the project execution. The report gives practical, evidence based strategies grounded largely on four key pillars, which I'll talk to later. I think the first one is policy and regulatory reform. We believe streamlining approvals, digitizing land registries, and ensuring transparent permitting or licensing processes are foundational. We think without having these policy and reforms, no amount of capital or goodwill will move projects forward. The other second key pillar is innovative financing. We believe we should crowd in private capital through blended finance, de-risking instruments, and ensuring that there are clear PPPs tailored to local realities. The third one is what we term digital integration. We believe digital tools and data analytics can reduce cost overruns, improve project tracking, and bring transparency to execution. The last one, which is an issue across not only government departments, but we find it mostly in government departments, it's capacity building. We believe that even the best policies and tech will not matter if we don't have a capable people and institutions to implement them. So we need to invest in human capital, engineers, planners, procurement officers, but we also need to make sure that that procurement process is friendly to the market. It doesn't take as long as it takes. So I think for us, this is a call to have a coordinated cross-sectoral action, because unless we fundamentally rethink how long it takes to get from feasibility to delivery, we risk continuing the cycle of underperformance, disillusionment, and exclusion. We think Africa is ready for us to build it. And for us, we also want to find ways where we can build a system that is faster, smarter, and more inclusive. Thank you.
Thank you so much for the context, Cabello. I'd like to move over to you, Leila, to give quite a broad global perspective. So, Leila, you sit on the board of the UN Global Compact, and so you've had a front row seats around what is happening around investment and infrastructure development, also from a sustainable perspective. Could you share with our viewers, from your perspective, what are some of the most pressing challenges when it comes to infrastructure development in Africa? And how does the lens from which investment is viewed in Africa compare to other emerging markets?
Mercedes, Africa faces a unique set of infrastructure financing challenges, and especially compared to other emerging markets. These include things like persistent gap between perceived and real actual investment, um, the uh, the actual investment risk, shallow domestic capital markets, weak project preparation, and fragmented regulatory environments. So, while regions like Asia and Latin America benefit from deeper financial systems and more mature investment systems, African projects are often seen as high risk, and this results in limited access to affordable capital. A fragmentation across borders and institutions also hampers the scale of cross border infrastructure. And at the same time, African infrastructure has to now meet climate resilience, digital access, and social inclusion goals. Despite these hurdles, the African Continental Free Trade Agreement has created a platform to drive regional infrastructure integration and to scale cross-border investment projects. And this is particularly in areas like energy corridors, transport networks, and digital infrastructure. So, as we're starting to see the attention shifting to investing in frontier and emerging markets, Africa must be a central focus, and particularly in the G20 initiatives. And this is in areas such as blended finance, just transition partnerships, and sustainable debt solutions. The UN Global Compact, on whose board I sit, also work to help to bridge the trust and the coordination gap, but by mobilizing responsible business and strengthening ESG frameworks and driving investor engagement to unlock Africa's infrastructure potential.
Thank you so much, Leila, for your input. So, moving over to an institution that is investing quite heavily on the continent and has deep expertise, I would like to bring Amadou in from the African Finance Corporation. Amadou, from your perspective, from where you sit, where do you see the most promising investment opportunities on the continent, and what is the AFC doing to unlock these opportunities?
Let me begin by congratulating Kabilo and the PIC for publishing this very timely report. And recently, AFC has commissioned, or it has published in May of 2025, a report titled State of Africa's Infrastructure Play. And within that report, it had clearly indicated that there are the continent faces seismic shifts in energy demand, industrialization, and its capital strategy. We at AFC have been working in close collaboration with some of our development finance partners, including PIC and the African Development Bank, to implement what we call high impact infrastructure projects through de-risking, and also be able to attract additional capital from institutional investors, and also from the private sector. So in terms of opportunities, we are seeing, I'll try and segment it into three sectors. If we look at energy, if you look at the energy sector, um, the continent is endowed with over 10 terawatts of solar energy potential, over 350 gigawatts of wind opportunities, and over 15 gigawatts of geothermal opportunities. Um, Only 6 to 7% of the hydro energy potential is being currently utilized. The continent has over 600 million people who do not have access to energy, and energy demand is even expected to double by 2025. So this kind of dimensions the size of the opportunity in investing in energy delivery within the continent. Another sector that we can look at is what we call the critical minerals sector. As you know, the continent has 30% of the world's critical minerals reserves, um, but only 5% of investments in mining is being directed towards African projects. So 30% of the resource is there, but only 5% of the capital is being directed there. So it shows that there's a huge investment opportunity within the critical mining space. The third aspect is what we call strategic industries, say refineries. Despite having being endowed with significant amount of oil reserves, we continue to import up to 55% of our finished oil products like fuel. Um, there is a conscious effort to try and increase that capacity through the Dangote refinery that was recently commissioned and heavily supported by AFC, and through refineries in Angola, and other West African countries. So there's also a huge potential, within the refining space. So to sum it up, energy, there is significant potential. You have growing demand, significantly lower production capacity as that now, but with huge potential given the reserves in solar, wind, and geothermal. And within the critical mineral space, as I mentioned, the world is moving towards energy transition, and the demand for these critical minerals is expected to grow by 500% between now and 2050. So it just shows you the size of the opportunity within the sector as well.
Sonia, you are one of the largest, as a EPPF, it is certainly one of the largest institutional investor on the continent. What is driving the EPPF strategy when it comes to investing in infrastructure around across Africa? And, how are you balancing the need to provide meaningful returns for 80,000 members that I believe you have, also providing also a social return in the process?
Thanks, Modise. Yeah, we're super excited about the paper that Cabello and his team at the PIC also brought out, because we think it's such a timeless conversation for a lot of the work that we need to do as South Africans, as Africans, but certainly also us as a pension fund. Our strategic imperative really into infrastructure across Africa is driven by a dual mandate, and that's really to deliver sustainable financial returns for our 80,000 members, but also to help contribute meaningfully to broader socioeconomic development. We are a defined benefit fund, so for us it's really important to have long-term asset liability matching investment opportunities out there. And infrastructure, especially sectors like energy and transport, digital connectivity that Kabelo was also referring to, and social infrastructure, provides a stable inflation-linked return that match our long-term liabilities. But more than that, we actually see it as a lever for economic transformation. We ourselves are guided by our sustainability policy, where we've got three different pillars. One is a social equality pillar, an environmental regeneration pillar, but also an economic parity pillar. And you can just hear how infrastructure really will hit it on the head of all three of those pillars. So we look beyond traditional ESG checklists and try and invest in infrastructure as an opportunity to catalyze a just transition as well, supporting decarbonization efforts, but also while uplifting vulnerable communities. This means that by prioritizing projects that provide access, inclusion, and resilience, we can actually, by investing in things like clean energy initiatives, include local participation, or housing and transport projects that also improve the mobility for underserved regions. And then we also recognize that infrastructure investment in Africa does require navigating complexity, as the previous panelists also pointed out. Whether we're talking about regulatory gaps, project bankability, or risk mitigation. And like the PIC has argued in their report, we also believe that institutional capital needs a broader enabling ecosystem that makes sure that we can invest in it. This includes everything from project preparation support to de-risking mechanisms, the blended finance structures that Kabelo was referring to. And therefore, EPPF is not only deploying capital, but we're also actively engaging with regulators, DFIs, and government platforms to make sure that we can help shape this pipeline. But I think more importantly, as we support the idea of creating scalable, fit for purpose vehicles, our own research echoes the PIC's findings that limited access to bankable opportunities, especially for the smaller pension funds and certainly more so for retail investors in South Africa, can be addressed through innovative listed as well as unlisted platforms. And so achieving impact requires collaboration across the broader spectrum of all of these opportunities. And we're exploring cross-border partnerships, particularly for digital water and transport infrastructure, where regional integration can really amplify a lot of the economic value and impact, I suppose. So we're excited about this space, and we think infrastructure investing is not just a diversification tool in a portfolio for a pension fund. It's really a strategic conviction for what it can mean for the future.
Thanks so much for that, Sonia. And I'd like to stay with you and just to further unpack some of the mechanisms or strategies that the EPPF is applying to perhaps finance smaller projects. So, you're breaking ground, Sonia, in terms of using tools like listed vehicles and the fund manager portal to unlock infrastructure investments. How do these innovations help you kind of like navigate financing smaller projects that do have a high impact that oftentimes get overlooked on the continent?
Yes, thank you. I think the first thing to recognize is that we're very much aware of the fact that meaningful infrastructure development in Africa, South Africa, and Africa cannot be achieved by just a handful of large pension funds. I mean, the capital gap, as the paper that the PIC produced also clearly pointed out, is simply enormous. So many high impact, smaller scale projects as a result, especially those in underserved areas and social sectors, tend to sometimes not get the attention that they deserve. And so we feel that it's important to take really deliberate, targeted steps to innovate beyond just deploying capital, but to actually make sure that we help build the infrastructure market. And two of those initiatives I think you've referred to in your question, which really the first one is the research that we actually did with Leila's team as well as input, but research work into the development of a listed infrastructure vehicle where we can help democratize the access for smaller pension funds and retail investors into infrastructure. And so creating a vehicle that can really mobilize the assets of asset owners in South Africa. And the second one that actually started a little bit more self-servingly for us, just as an efficiency mechanism, but that we can see playing a broader role into the industry is what we launched as our fund manager portal, designed to improve information flow and also the test the investment readiness of infrastructure in the ecosystem. The investigation into the listed vehicle is to create a publicly traded investment structure. And after extensive research for all the various pros and cons and what will make it work, we do think that having a listed vehicle on the JSE is something that will enable the smaller pension funds to access infrastructure opportunities that they otherwise won't be able to do, simply as a result of the higher minimums and illiquidity barriers. So it's really trying to lower the barrier to entry. It also, obviously, because it's a listed vehicle, that helps to build transparency. And it's also there to help create scalable infrastructure that can then be channeled into both greenfield and brownfield projects. So we're excited about the research and what it can mean for the industry. And then the fund manager portal is really a digital means for us to bridge what we often see as a communication gap between infrastructure project sponsors and the capital allocators. We often don't speak the same language, don't meet at the same places. There isn't clarity on what the deal flow opportunities are and what the bankable opportunities are. So one of the challenges we identified is therefore that smaller, especially smaller, promising projects often falls through the cracks, not because of the lack in their merit, but simply because of the lack of visibility. Also, clear communication and or documentation, and often the turnaround times that are needed to meet institutional requirements. So this portal is really something that we try to put together, that we can see the role thereof can be to standardize and also help streamline that assessment process for capital allocators. It helps to flag priority sectors. It also helps us to reduce inefficiencies in matching capital with projects. So it's something that we're super excited about. Both these tools are therefore ecosystem building tools, as we would call it. We're not just investing, but we're helping to design the infrastructure of infrastructure investing, if I can call it that. And that speaks to our broader belief system that if we want long term inclusive development, we have to be able to expand the universe of participants and reduce the barriers that prevent transformative ideas from getting funding. And that's really aligned to not only our fiduciary lens, but also the lens of other institutional investors and pension funds within South Africa.
Thank you so much, Sonia. So, Leila, moving over to you, you contributed to what some of this research and this development that Sonia was, telling us about. Can you explain a little bit around the JSE's role?
Musidi, Africa needs regulatory reforms that open clear and sustainable paths for private sector participation. It's very much in the same way as Operation Vulindlela opened up enablement in the reduction of mobile data costs, the clearing of water, licensing backlogs, and the creation of the 22 1,500 megawatt renewable energy pipeline. And these are all examples of targeted reforms that can unlock investment. At the JSE, we are pioneering and leading an effort called Operation Phumelela, which is a capital markets reform project from private sector, and it seeks to improve capital flow into infrastructure through attracting multi currency investments, improving the ease of listings, particularly into small caps. And that includes private capital and standalone infrastructure projects and concessions. Insofar as products go and innovation, we have for a long while known that REITs are an efficient structure for capital raise due to their tax flow through nature, and the distributions from REITs, as we all know, to investors are pre-tax. And the JSE has expanded the current property REIT framework to include infrastructure REITs, which can fund things like power generation, electricity transmission lines, data centers, and even fiber lines. We are in discussion with large infrastructure investors to list their private assets as listed REITs, which is very exciting for our market. We all heard not so long ago that National Treasury announced their intention to introduce infrastructure bonds, and we are working with them to develop an appropriate product framework to launch infrastructure bonds on the exchange. If I think more broadly, the freight logistics roadmap and the push for independent transmission projects show the kind of structural changes that can attract capital and improve liquidity of financial instruments. These reforms, they reduce uncertainty, they shorten the lead times, and they increase transparency. And this makes infrastructure assets more bankable and more appealing to both domestic and international investors. So, in summary, what's needed now is more of these reforms and faster rollout. The JSE plays its part by advocating for regulatory clarity, designing investment products that are very much aligned to these reforms, and also integrating technology and the ESG standards to deepen our market participation.
So let's look at like funding big infrastructure projects on the continent. So the paper that PIC published indicates that up to 80% of the projects on the continent tend to stall for various reasons. So Amadou, my question to you, it would be interesting to understand from your experience what are causing some of these delays, and from a regulatory perspective, what needs to start happening to start unlocking this so that they can serve as meaningful opportunities for pension funds like Sonia's and Cabello's to invest into these projects?
Okay, thank you very much. And I'm going to respond with some specific examples. I think Cabello, in his opening remarks, had mentioned the need to reduce the time it takes from conceiving projects to their delivery. Um, I was opportune to be part of a think tank under the auspices of the OECD. This was like 6 years ago. And we were looking at, and it was from a request that the former Ghanaian president made to try and understand why it takes so long to develop infrastructure projects on the continent. So we did a comparative assessment. We looked at the timeline it takes from when projects are conceived in China, in North America, in Europe, and also in Latin America. And for large scale infrastructure projects, just their development cycle on average was between 7 to 10 years. And in most of these other regions is between 3 to 5 years. So so we had to dig deeper into what are the underlying reasons and causes. And I'll give you some specific examples. We looked at a project in Senegal. It was a 360 megawatt gas to power. And Senegal had significant experience with IPPs, that's independent power projects, and they had successfully negotiated um, uh, um, uh, project documents, templates that were deemed to be bankable in order to attract, financing from international investors as well as development finance institutions. And what has been happening project after project, when a new project of that nature is starting, they always used to go and start afresh. You start with your original templates for your, say, your PPA, which is your power purchase agreement, and you negotiate again with your new investors. And after 2 years of negotiations, you come to almost the same point that you had finalized with your previous project. So we went into Senegal and told them, look, you can significantly reduce the delivery time by utilizing the templates that had already been deemed to be bankable in a previous project and use that as the initial point of negotiations for your new projects. And we did that within 18 months, we were able to start construction, which ordinarily would be between 3 to 4 years for you to be able to do that. So these are, in as much as you have regulatory reform, there has to be additional awareness to be able to narrow down the time that it takes to develop projects. The other example I want to give is a project we did in Djibouti. It is a wind energy project, relatively small for most of the DFIs, maybe a total project cost of 120 million, 60 megawatts. And the current project finance architecture, it has so much inherent delays that's built into it, especially with regard to attracting debt. The process of onboarding development finance institutions, the process of procurement of, to appraise the projects, get the do the necessary due diligence, the process of going through your credit committees, etc., is significantly long. So in Djibouti, with AFC, together with some very strong partners, we said, look, the project finance timetable from when you contact the lenders to when they are ready to sign a check is between 18 to 24 months. He said, for a relatively small project like this, let's implement using an all equity financing scheme. In parallel, we start engaging with the lenders, and when the lenders are ready, you restructure or you refinance part of the project with debt. We were able in Djibouti within 16 months to start construction. The lenders started their process, and by the time that they were ready, the project was 75% completed. So it means that you had, if we were to wait for the lenders to be fully ready, that will be having the point that we will be starting construction. It's going to take another 2 years. So it's like you already save like 18 months in being very innovative in the financing that you put, which for me buttresses the point that Cabello made with regard to focus on policy reforms, innovative financing, and institutional capacity building. And that's the last area that I want to I'll end. Um, what we've realized, governments used to implement infrastructure, which is natural. Infrastructure, it's a highly regulated sector, and in the past it used to be implemented, financed solely by government. Now there's argument, given the size of the deficit, that you need to attract additional capital, and here comes the private sector. But what we've discovered across the continent, in most jurisdictions, most of the government counterparts are used to that previous model of infrastructure delivery. They don't have project finance experience and all these new financing, innovative financing tools that are at the disposal of other continents and other regions, which we are trying to implement in the continent. So there has to be a conscious effort to build the capacities of government institution to be able to sit opposite the private sector in order to negotiate some of these innovative ways of financing infrastructure.
So, wow, Cabello, 5 to 10 years to finance a project. That is pretty lengthy, and worries that as a pension fund, you don't have time to waste to kind of, look for the opportunity to find those meaningful returns. How have you navigated some of these challenges around investing into infrastructure as Amadou eloquently kind of, highlighted to us?
Thanks again, Musidi. So from our side, we've used a variety of ways to invest. I think, first of all, we welcome and support the opportunity for listed bonds or listed infrastructure projects where there is transparency and where there is a pooling of capital across a variety of sectors. But the other way that we have endorsed from the PIC side, we have specifically either bought equity into the likes of your Africa Finance Corporation, also your Africa 50 and other institutions that tend to move slightly faster than where we are as asset managers who manage capital on behalf of pension funds. And our equity in those institutions, we classify it as strategic. So we do believe that we need to ensure that we can create a shared investment platforms for project pipelines. So we know that investors, typical institutional investors, require visibility, they require trust, they need scale, they need bankable projects wrapped in acceptable instruments. And for us, hence, we have made investments in the likes of your Africa 50 or your AFC and others. We believe these provide a platform to pool capital, largely on the unlisted side, share the risks, but collectively prioritize regional infrastructure projects. The second key part is that we need to harmonize the regulatory and policy frameworks across borders. And the one way to do that, we know that cross border projects often stall due to conflicting regulations, fragmented standards, and weak legal enforceability. So, for us, going through via some of these institutions, which may have a preferred creditor status in some of the countries they operate in, provides that risk layer or risk mitigation layer to us. We also believe that to co-invest effectively, capital allocators need a common due diligence template, which is what was covered earlier. It's very critical. If you have a common due diligence template, that can save, we've just had your time from 5 years to potentially just 18 months. We also need to ensure that there is an alignment with regards to tax policies across regions, especially when it comes to infrastructure. What we've learned from the PIC is that we also need to find a dispute resolution mechanism that transcends national silos. So if we put capital in country X, and but that capital in country X, there are issues in that particular country, how do we have a dispute resolution mechanism that protects everyone? The last one is I had said it earlier that we need to deploy blended finance and risk mitigation tools to crowd in capital. So we know that risk perception, not just actual risk, is holding back capital. Tools like first loss guarantees. We also need to find a way for currency hedging mechanism. It has been very difficult on the continent. And the last one, we need to have consensual tranches, which we believe can shift investor sentiment and improve bankability. We think that the domestic institutions can partner with the DFIs to create risk sharing facilities. So your DFIs and institutions similar to your AFC, Africa 50, have the skill set to do project preparation. You don't normally find that skill set in a pure fund manager, but they can ensure that as part of the process, that part of making sure that they bring an instrument that investors, long term investors, can invest in, they can prepare it, reduce the risk, and ensure that in a blended financing structure, it's very clear that we can optimize those who are looking for what we call value capture financing, those who are looking for social impact, and those who simply want infrastructure linked to debt securities to play in and support those vehicles. We do think collaboration amongst all stakeholders should not be aspirational; it's essential. What we need now is the systems, standards, and the shared vision to deploy it at scale and at speed. Yeah. So from our side, we know that the global capital is not looking onto our continent. And we do believe that we need to mobilize African capital to finance African infrastructure. Thank you.
You mentioned the co-investments that you have with the AFC and the Africa 50. Could you maybe just highlight, like, as an example, how is that working? And then I'll further move on to you, Amadou, to just also just explain what has been this mutually beneficial synergies between the PIC investing in the AFC.
Yeah. Maybe I can just highlight one. I think our investment in AFC is now nearly 2 years old. So largely we've bought equity into the business, which allows the business to then on lend some of the capital that we have invested in. But we've always said this is an opportunity for us to become strategic partners across the continent, and there will be opportunities outside of South Africa, but there'll also be opportunities at home where we may potentially co-invest. So recently there is a transaction, it's called Nyaza, where it was largely led by the AFC team, but the unlisted infrastructure team at the PIC also co-invested with them. So like I said, we see ourselves as long-term patient capital investors. Our key strength is being financiers. We are not strong in potential what the AFC team would do, which is basically project prep. But what we understand is asset fund management and investments, and we need to play to each other's strength. So that's sort of how we have done it. We do think going forward there could be more that we do with them, and also that we will do with other partners going forward. Thank you.
So, Amadou, on the project preparation, aspect that is involved in infrastructure finance, could you tell us a little bit more about your role as AFC in this strategic initiative that you drove through Anyanza with the PIC?
Yes. Maybe I'll start the response with blended finance, which for us is vital for Africa's infrastructure strategy because it helps to de-risk projects and also to mobilize additional capital, especially institutional capital, long-term institutional capital, like from the PIC. But what we believe also is that blended finance needs to be integrated with other solutions. So Cabello made reference to force loss. AFC set up a wholly owned subsidiary called Infrastructure Climate Resilient Fund. It's a $750 million fund, which attained first close for almost 400 million towards the end of last year. And we were able to attract $240 million from the Global Climate Fund as a first loss investment, and also attract 52 million from European Investment Bank. AFC put in another 60 million, towards that fund. And the whole idea is with that first loss investment, we should now be able to crowd in additional investors like the PICs of this world and other institutional investors. From a project development perspective, because most of the institutional investors, they don't like, they prefer to come in at a stage when the project has been significantly de-risked. And that is where the value addition from AFC lies. AFC, from the very onset, had realized that the problem of or the lack of infrastructure within the continent is largely due to the non availability of bankable projects. And I think that's you can glean from the PIC report that 80% of projects never get to bankability. So we had felt that that is the area of focus that the continent need to do a bit more in order to have that pipeline of bankable projects to be able to attract. I think there's significant amount of capital out there, but you need to bring them in through the risking of opportunities and demonstrating bankability. So the partnership that between AFC and PIC revolves mostly around that. We are looking at a titanium pigmentation plant called the Nyanza, for which we had some local South African developers. But we came in as a co-developer to provide support, our experience in driving projects from that concept stage to bankability. And we've been able to work with them over the past year and a half to the point that we are now attracting institutional capital and other investors to the project. So it's like a $700 million overall project size. But all the project development work has been done. Project has been significantly de-risked, and we are now attracting capital from within South African institutional investors and outside as well. So those are the type of things that need to complement blended finance if we are to make a significant impact. The last example I want to give, which also involve co-financing or collaboration among other institutions like DFIs and even state governments. AFC has recently started developing what we call Lobito Corridor 2, which is a 800-kilometer rail line running from Zambia through to Angola. And the whole idea is to provide that corridor, which is endowed with significant amount of minerals, to be like a zone for value addition for some of these minerals, and also provide that transport linkage, to port. What we thrive at AFC is we don't just give isolated solution. If you look at mining, we do what we call pit to port. We provide investment in mining the product. We provide the energy that is needed to do the mining. We provide the infrastructure that is needed to transform the mine products, be it 24 hours energy supply, the internet connectivity, the LAN, all the necessary supporting infrastructure that is needed to do value capture. And then we provide the logistics to export if need be, the product. So our approach to infrastructure is more from a holistic perspective. Some call it the ecosystem approach, and that's the best way to capture value and impact within the continent.
Thanks, Amadi, for that context. So I'm really curious, Sonia, in from an EAPPF perspective, how are you navigating this kind of predicament around infrastructure being perceived as being illiquid as well as low yielding for pension funds?
Yes, thanks, Modisi. I think there's perception and then there's reality. So there certainly are opportunities within the infrastructure space that have yielded mixed sets of results for us as well as a pension fund. But overall, we still find it a compelling and an evolving asset class. I mean, if you listen to the conversation, different platforms, different instruments, different entry points for it. So I think it's really a matter of sizing for the right opportunities and understanding what you're getting into, and then also using the de-risking mechanisms as much as you can. I think the biggest risk that our pension fund have been worried about in the past is not so much liquidity because it is a relatively large pool. It does have a long-term liability profile. It is a defined benefit fund in design. So you actually do have a good sense of what your cash flow requirements are. But it's much more important that you understand by when you need which level of liquidity and then to size for the investment opportunities in the right possible way. To the points that Leila earlier made in terms of infrastructure REITs and green bonds. I mean, there certainly are other vehicles, even our own listed vehicle that we were discussing earlier, that can help you with stable long-term cash flow results. And you can often have it underpinned by regulated or sort of concession-based revenues, and all of those help align it with a predictable liability profile of the pension fund, but also make sure that you can solve for the right level of liquidity. So I think that there are mechanisms. I think our industry is still in its infancy, and certainly asset owners are still learning how to use it from a portfolio construct perspective, what mechanisms you can use, what tools you can use to make sure that you size for it appropriately. But I don't think those need to be deterrents in what is really at the core an attractive asset class for a pension fund to be invested in.
So, Amadou, just to close off, I would like to start with you. It's been clearly highlighted that it's not in planning for investing in infrastructure, but the execution that needs a little bit more work. So, in your view, what kind of collaboration needs to take place between governments, DFIs, and institutional investors to move infrastructure projects not just from pipeline but into implementation?
Thank you. So I'll try and segment my response. Look at it from the government side. I think part of the conversation we had indicated the need for capacity building within government to be able to embrace the new innovative financing mechanisms that are coming into play. There's also the need for government to reorganize itself, because if you look at infrastructure, there are so many touch points with government, and I think every touch point is a cause of delay. You typical infrastructure, you need to go to the Directorate of Lands to do that. You have Ministry of Transport, which is the party. You have the Ministry of Justice, Attorney Generals. You have Ministry of Finance, who are experts in financing. Some countries, they don't even have PPP regulations or laws passed as at yet. So regulatory reforms, yes, for sure. Capacity building, yes, for sure. And I think openness in terms of government to new ideas and also towards digitization in order to be more nimble and more streamlined from a process point of view. At least that's the expectation from government. Within the DFI community, I think Cabello touched on it a bit. There's need to be closer collaboration, even maybe having harmonizing, our due diligence templates, or being able to rely on the work that its similar-minded institutions has undertaken for you to also do that. I think those are areas where one can save significant amount of time, because infrastructure projects, there is no one institution that can finance this large scale infrastructure project. So you need multiple financing institutions. And if each institutions want to come and impose its own due diligence processes and procedures, it just prolongs the overall delivery time for the infrastructure. And then the last segment for me is the institutional investors, like pension funds. There is definitely the need, if we are to make any significant impact on infrastructure delivery and financing, we need to raise domestic capital. It's very, very important. And we have experience doing that. Recently, we helped Nigeria raise a $900 million local domestic bond. So it was just through local investors. So the country didn't have to go and borrow, and all the things associated with borrowing outside. So capital is significant. Capital is within the continent, which needs to be harnessed. But in order to harness that, we need to be investing in project development and having that pipeline of bankable projects to give comfort to these institutional investors to be able to bring that capital into African infrastructure.
Excellent. And to segue into a very important development here on the continent, Cabello, closing with you, and I'll address a similar question to you, Sonia. South Africa is chairing the G20 summit, and we've got a rare window to put Africa's infrastructure on the agenda front and center. What would you like to see in terms of leveraging this moment to create progress across the four key pillars? Amadou alluded to some, the policy reform, innovative finance, digital integration, and capacity building. What would you like to see as successful outcomes from the G20 presidency?
Thank you, Musidi. We believe there is a bigger role that asset managers, retirement funds, and others can play to help fund public infrastructure. In South Africa, Reg 28 was amended to allow retirement funds to increase their exposure to infrastructure as an asset class, but we have not seen the follow through yet. As a continent, we also have not tapped into global sovereign wealth funds. So, first, the capital must start from home through the pot of retirement funds that we currently have. But we do believe there is an opportunity to crowd in the global sovereign wealth fund or even global capital allocators in order for us to ensure that this pool of funding can accelerate infrastructure development, as we believe it's long term and most of it is patient capital, similar to us. So yes, so I think we will continue on the 14th of August. The PIC will be having another infrastructure dialogue that will be unpacking listed and unlisted financial instruments to fund infrastructure in a lot more detail. And in that session, we will focus on the role that asset managers and sovereign wealth funds can play. So for us, out of the G20, we would like to, for us, a success factor would be seeing an increased allocation towards this infrastructure from the pool of capital within the domestic pool, but also attracting offshore capital into infrastructure. Thank you.
Sorry, in closing, moving over to you, Leila, just to build on Gabelo's points around attracting capital from sovereign wealth funds, what do you hope for South Africa's G20 presidency in terms of unlocking global investment and capital flows in the country as the largest exchange on the African continent?
Masivi, South Africa is hosting the G20 in 2025 can unlock capital flows in several ways, though it's not automatic and we shouldn't take it as a given. it all depends on how South Africa leverages the platform. Some of the key potential pathways include, for example, enhanced investor confidence and visibility. So, from a global spotlight perspective, hosting the G20 puts South Africa in the global economic spotlight and gives us an opportunity to showcase governance, economic reforms, and investment opportunities. It also gives us narrative control. South Africa has the opportunity to position itself as an economic hub or a gateway into Africa, and thereby for us to sort of emphasize stability reforms, growth sectors like energy, infrastructure, and fintech. Then, from a policy commitments and structural reforms perspective, it gives us an opportunity to signal reforming. So, if the government announces credible commitments on fiscal discipline, energy reform with ESCOM or SOE governance, or regulatory clarity, we have an open stage, and this could genuinely reassure investors. Of course, as long as we make good and deliver on our commitments. And then, in terms of public private partnerships, launching investment friendly frameworks or something like blended finance mechanisms could, at the G20, could attract institutional capital. And then, of course, Kabelo spoke a little bit about, mobilizing finance and investor engagement. So, from an investor engagement and deal-making perspective, there are many investor roundtables which are hosted inside events with global asset managers, sovereign wealth funds, and PE firms, and that could facilitate direct investment discussions. And then, in terms of mobilizing development finance, access to climate finance and infrastructure funds, really the G20 gives us a key platform for climate finance discussions, and South Africa could use this platform to attract concessional financing for its just energy transition. And then, in terms of de-risking some of our instruments, the forum could be used to secure multilateral backed guarantees or risk sharing mechanisms to crowd in private investors. So it's really all about expeditiously making use of that platform and putting forward a credible and convincing argument to international policymakers and international investors.
Great stuff. And Sonia, coming over to you in closing, G20 around the corner. What does success look like from an EPPS perspective?
Yes, I think it's such a brilliant opportunity for us to do what Amadou and Kabelo was referring to. That it's an opportunity for us to really coordinate this whole ecosystem a lot better. I really think that the G20 can be a real significant global catalyst, but not only for us to make declarations like we've done in the past, but that we actually move to execution, the demand that Kabelo made. Let's see if we can get there. I think the presidency is not just a diplomatic milestone for us as South Africa, but we need to see it as a strategic opportunity to really place infrastructure front and center of Africa's growth agenda. I think on policy reforms, to get to the points that were made earlier, we must see the G20 platform to push for common standards on project preparation, things like procurement transparency, regulatory consistency across the African markets, because it's often that policy unpredictability that's chasing capital away. We know that, and it was said earlier as well. So I think South Africa can, by using the G20 infrastructure working group, champion reforms that streamline approvals, will really accelerate the Triple P framework, but also help to harmonize regulation going forward. To Kabelo's point as well, it's an opportunity for innovative finance to be put front and center. The G20 should in my mind, be used as an opportunity to convene multi-stakeholder coalitions, governments, DFIs, public investors, exchanges, and the asset owners to scale blended finance tools that can help de-risk um, infrastructure investing. I also think it's a digital integration opportunity where infrastructure isn't just roads and bridges. It's to the points that were made earlier. It's fiber, it's data centers, it's energy platforms, it's all of those things. Digital connectivity underpins competitiveness, and so this G20 presidency of South Africa, in my mind, can also be used to push for public-private partnerships on digital infrastructure and for much better regional coordination on platforms like smart grids and integrated payment systems. So this is where I believe Africa can leapfrog, and as pension funds like the EPPF, we are ready to invest in those opportunities. But it's really an opportunity for us to put the right conversations front and center. And I think lastly, it's just that capacity building that Kabelo was also referring to. We don't just need capital, we need the execution capability. And South Africa can use the G20 moment to scale up infrastructure development from a training perspective, from a technical assistance perspective, whether for municipalities and the SOEs. But it's also helping us build a pipeline of African infrastructure specialists and having the skills together to align in actually mobilizing a lot more of the assets. So I think it's a brilliant opportunity for South Africa and for our industry to play more of a pivotal role to unlock infrastructure investing.
Yeah, I couldn't agree more with you, Sonia. Well, this brings us to the end of our conversation. Thank you to you all for such a rich and practical discussion. The PIC will be driving more of these conversations as we move towards November 2025. So, a huge thank you to you, our viewers, for joining
Thank
us.
you.
And till we see you again next time, bye for now.